quiet, as we know, Brooke, during the height of the GFC. Let's bring Stephen Nash from FIIG Securities into this one. Good morning, Stephen.
Morning.
You know, as we were saying, it's not just though one exit that matters here. We've got the Fed as well that's still in the game. How does it all play out?
Well, I think, as you mentioned, those housing numbers are evidence that the still problems with the US housing market, and that they may form an impediment to growth. However, there is a sort of a growing momentum in the US market, and the recovery is gaining some pace. But I think these housing numbers just remind us that we shouldn't get carried away with being complacent about that recovery at the moment.
Well, this is the thing. So why now, I guess, is the question. Why make this call from the Treasury that it is going to start winding things back? Because the Fed did say as much when it came to its asset purchase program, if you recall, and then only had to go back in there and make new purchases.
Look, I imagine that you know, the selling of these mortgage securities is part of their overall strategy, in the sense that they may need to reload at some stage and be able to repurchase these securities. That's a contingency I think they've always got to bear in mind, but I don't think it's a really significant thing for the Treasury market. The Treasury market's held in quite well, given that very large rally in equities overnight. I think a lot of people are also looking at this as a bit of a pullback in bond prices with an idea to reload. We do have elevated oil prices, which I think will continue to constrain growth. So I think people are hanging in there with regard to the bond market right now.
This is the thing, maybe we can ask you a similar question that we asked Michael earlier, Stephen, as well. You know, to say that Treasury move is perhaps a sign of stabilisation for the mortgage market, but yet then how does that sit alongside indicators like those existing home sales numbers which came out? And I might even go further. I mean, when you look through some of the numbers, you're seeing all cash sales of houses at a record 33% of total purchases, because the lending restrictions and requirements are so tough there. People just want to pay cash for properties now.
Yeah, well, I think the stabilisation of the housing market is a really important part of the recovery story. It is participating in the recovery, but it's got difficulties. I mean, you still have high levels of unemployment. People remain very cautious about making that commitment right now, borrowing any money. It's really a similar story in Australia. The people have become much more conservative in their borrowing patterns. So that's really a function of the global financial crisis, and I imagine it won't be going away, anytime soon.
Is the Treasury fundamentally going to make money out of this exit in the same way that governments were a backstop for banks at the height of the global financial crisis, and then those same banks rewarded them for rescuing them with a healthy rise in their share price? What's the story here with the exit?
Well, I imagine that's really not the point here. The point is to support the financial system in a difficult period. I imagine that the Treasury will make some return on its investment, as it typically does. However, that's not really the point. The point is to make sure the financial system is functioning adequately, and I think they'll continue to do that, and there may be further use of monetary policy get down the track. Possibly that QE3 is still in people's minds at the moment.
Let's cross the Atlantic, shall we, and let's look at the UK overnight, because consumer confidence levels there are pretty ugly at a time when we're talking about the Bank of England raising rates. Yes,
look, the confidence is really, really low. They have substantial cuts to the public sector coming through. I imagine that the UK is in a pretty tough position right now. I think the effects of the cuts will be felt later this year, and that will depress confidence even more. So the Bank of England is responding to pressures via the commodities and currency, but hopefully they can constrain that increase in rates to possibly one rise. I hope it doesn't really tip the bucket there again. They have a very difficult situation there right now.
I mean, all around the world we're saying central banks are in a very difficult position at the moment. Is the UK central bank in a particularly difficult situation, or nothing out of the ordinary for central banks at the moment?
No, I think it really is. In all, looking around the world, it's got quite high inflation, and it's also got fairly precarious growth prospects, I think. So it's in that stagflationary situation at the moment. It's yeah.
In fairness, Stephen, have they not been writing to the government for months and months and months justifying why inflation is running outside their target band? So they haven't tamed it until now. Why crush consumer confidence at this moment in time if this has been a problem for nearly 12 plus months?
That's exactly the consideration I think they're going through right now. That is a really important point. There have been some commentators arguing that there should be a new investment bank created. However, the response to that is that the UK government already owns 2 major banks, and why create another one? I think the idea there is to focus on the longer term and possibly to stimulate some spending at this time. But again, you know, the policy options are really limited.
Can I bring it back to the Australian situation as well, Stephen? Yeah. Because we have seen the market being pricing in rate cuts through this course of the volatile markets. Yeah. Are we, in fact, ruling out further rate rises at this stage? Where are we at?
Well, since the peak in 3-year bonds, we've come back about 25 basis points. 3-year bonds trading around 5% right now. So we have the market starting to build in another a rate hike, maybe one by the end of the year. I think that's fairly reasonable, assuming that the oil price doesn't depress global growth. So that's a big assumption, and I think that's why the market hasn't been pushing rates even higher than it has. I think if that oil price depresses global growth, we'll get those 3-year bonds rallying again.
Stephen, all eyes now on Thursday with statements from the Reserve Bank. For now, thanks so much.
Thank you.
Appreciate it.
Thank you.
Dr. Stephen Nash from